This is Scott Becker with the Becker Private Equity Podcast. We're joined today by Matt Wolf, Senior Brilliant Leader at RSM. He talks to us regularly about what trends he's watching in private equity. Matt, I'll tee it up, then I'll ask you to start taking us away. Just when it seems like things are moving in the right direction, that interest rates are going to stabilize, the Fed sees some bad inflation data and signals that they're going to continue to, that the work's not done. What's your sense of that? What's your sense of what's happening with the private equity market, the business deal market, and what else are you watching closely that you're thinking about? Matt, let you take it away.
Yeah, thanks, Scott. I mean, it's a great question. Chair Powell was on Bloomberg TV earlier today, sort of not necessarily walking back those comments, but just explaining that, with the 10-year where it is, and some other governors have said the same, that maybe there's not a need for a hike. I mean, there's been a lot of noise around all of that with the interest rate environment. But like you said, I mean, the fact of the matter is we have 10 years near 5%, and the rates are just, they're going to be higher for longer. And I think, a lot of the sponsors, at least, that I've been talking to and working with, they're kind of coming around the fact and the idea that, yes, we're not going back to a zero interest rate environment anytime soon, and we're trying to deal with that. I think, one of the challenges that we've been focusing on and spending a lot of effort around is really just fundraising, right? And what does the future of private equity look like with, if institutional investors can get 5% on a 10-year, what does that mean for trying to raise new funds? Especially with, the challenges of operating that we've seen. I did see a really interesting data point on the fundraising environment that suggested, year to date so far, we're really only about 13% behind where we were last year, which actually surprised me. I would have expected we were down more than that. But what I'm watching now, what I'm focused on is what does that look like going forward as we get into the next FOMC decision, as we start to see private equity funds report their third quarter and their year-end marks to their limited partners. And we probably see some of these older funds that initially invested, 4 or 5 years ago trying to exit. Where are they able to exit, and what does that signal for the fundraising environment? I see that there could potentially be some sort of confluence of headwinds in the fundraising environment, right? We have these higher rates for longer that will influence capital allocations. We'll see private equity firms finally take a lot of markdowns that will be reflected to those limited partners. And we'll just continue to see kind of margin and other challenges as well. And it'll be interesting to see how that all plays out with the future capital flows to private equity in 2024 and beyond.
But your point is really well taken. If people can get safely 5% plus, then the margin they have to get to invest in private equity has got to be much, much higher than that. And it's harder to find those margins when the costs of debt are so high as well. So it's for some period of time. It's not that the future is gone for private equities. It's certainly not. But it does mean for a period of time, returns are going to be more challenging. And so fundraising is more challenging. You also see what's fascinating is people starting to raise traditional private equity funds, starting to raise funds around potentially distressed assets. Like one of the private equity funds that we're an investor in recently started raising a real estate fund intended to take advantage of distressed assets when that carnage comes. Any thoughts on that and what you're seeing out there in terms of the direction of private equity funds?
Yeah, I mean, I think that makes sense, and it sort of plays to this broader theme and cyclical change that I think we've talked about before, Scott, where, in the prior interest rate environment, as a private equity fund, if you were good at sourcing deals, you could make a very healthy, happy return for yourself and for your investors through sort of financial engineering, right? You could buy companies and kind of exploit multiple expansion and make a return that way. And that was a very valid and profitable way of generating returns and creating value. Going forward, I think what's going to create those returns and that value will really be operational experience, expertise, and excellence. And so seeing these funds that focused on turning around distressed assets, it just makes sense, right? It's a natural extension of that recognition that we're no longer able to kind of benefit from the same types of multiple expansions. So we need to focus on operational excellence. And if you have the qualifications and the wherewithal to do it, distressed assets is a great place to do that, or can be.
No, thank you. And you mentioned the mark-to-market effort when funds have to do that. How, and you're in the valuation business, just talk a little bit about what that looks like and how people do that. So I know funds are very concerned about showing big markdowns because then it makes it harder to instill confidence in investors. At the same time, they don't want to surprise investors. So what do you see out there in that mark-to-market effort, and what can you and can't you talk about?
Yeah, I mean, I think in general, if people are unfamiliar with the process, right, what happens is the fund managers will look at their investments and they'll say, okay, did the value go up? Did the value go down? Did it stay the same? Why or why not? And then that will get reported to investors, and depending on certain characteristics, their auditors will look at that either every year or every quarter and do some testing around that. Now, the testing that the audit firms will do on those valuations isn't necessarily to say, yes, this is the right valuation or the wrong valuation. It's really just to test those fund managers' processes around how do they get to their valuation. And typically what we, in every firm, every shop is a little different, I would say, but often typically what we see is, again, to your point of you don't want to mislead investors, but you also don't want to surprise them. Generally, managers tend to hold their investments at cost unless they have a good basis to say, yeah, the value has increased or the value has decreased. And we've seen a lot of managers continue to hold those investments at cost as interest rates have risen. But as those funds get longer in the tooth, they get, they get towards the end of that hold period, or, they're now a couple years into margin compression. I expect we'll see a lot of fund managers that have little choice but to mark down a lot of those positions.
Fascinating. And fund managers sort of hate to do that, but also they hate even more if they surprise investors on exits, and exits are much worse than they expected. And at the same time, they have some control over how long they hold, but how rigid are the fund guidelines in having to get out of something at a certain date, or can they hold longer if they need to, just thinking the company, the markets will recover? How does that look?
Yeah, I mean, the guy, it'll depend on the fund, but I don't know of too many funds that have very set in stone guidelines in those exit dates. What really happens is just the pressure from the limited partners, right, from the investors in that private equity fund. They're calling up their investor relations people. They're calling up the chairman, the senior vice presidents of the firm, and saying, listen, it's been 5-6 years. We want to recognize these gains, and the fund managers want to do that so that then they can roll those investments into the next fund. And we've seen that that hold period drive exits that I think many managers would say, yeah, if it weren't for the fact that we had been in this position for this amount of time, we would have never taken this deal. But we needed to exit. Our LPs were pressuring us to kind of start churning the fund, and we're trying to raise money for our next fund. So we gotta pick up and move on. So we took a deal that a year ago we wouldn't have even looked at.
Fascinating. Matt, anything else that's top of mind for you that you wanted to share with listeners today?
Yeah, I think, going back to kind of the fundraising environment in general, I think, I shared that stat of total fundraising is only down 13% year to date over prior year. But if you look at the decomposition of that, it's because, it's not as, the fundraising isn't as low as I think a lot of us might have expected prior to that report coming out, because so much of the fundraising has been concentrated into sort of the big giant players. And so I think middle market funds are having a more difficult time raising than, like the big gigantic players. And that just kind of goes back to how we're going to have to focus on what is our differentiator? Why is our money greener than somebody else's? What is the operational excellence or whatever differentiator that we bring to the table as middle market funds, as we're out there competing for LP dollars, more of which is now flowing to treasuries or flowing into private credit or things like that. So it's probably going to get more difficult before it gets easier to raise money, but there still is a solid interest in private equity, of course.
Fascinating perspective. Matt, I want to thank you for joining us in the Becker Private Equity Podcast. We'll get this episode out right away. Thank you so much for joining us.
Thank you, Scott.